100 years ago, 5 runners lined up at the start of a race. Each carried the same $100. One bought stocks, one bought gold, one bought government bonds, one kept cash in treasury bills, and one stuffed the notes under a mattress. The race has now run for a century, through a depression, a world war, oil shocks, tech manias, and pandemics. The final standings will bend your brain. But watch the race first, because it was never a straight line. Barely 3 years in, catastrophe. The great crash of 1929. Stocks lose 89% of their value. The stock runner is face down in the dirt. A generation swears off shares forever. Gold and bonds glide ahead. The mattress feels like genius. Then decades of recovery until the 1970s flip the board. Inflation hits double digits, and gold, freed from its fixed price in 1971, goes vertical, up over 20-fold in a decade. Stocks go nowhere for 10 years. Cash burns invisibly. The 80s and 90s reverse it. Again, inflation is tamed, and stocks rip through the greatest bull run in history, while gold sleeps for 20 years, losing value from 1980 all the way to 2000. Then the 2000s. Dot-com bust 2008. Stocks halve twice in 1 decade. Gold triples. Every runner has a golden decade. Every runner has a lost one. So after a full century, the standings, the mattress still holds its $100, which now buys what $6 bought at the start. Inflation quietly stole 94%. Zero volatility, guaranteed loss. Treasury bills, safe cash earning interest, about $2,000. Government bonds, roughly $14,000. Gold, about the same, $15,000. But what a ride! 2 spectacular sprints and 40 years of sleep. It's insurance that pays in panics, not an engine. And stocks? That $100, dividends reinvested, is worth over $1 million. Not double the others, not 10 times, 100 times the runner-up. Here's the mathematics hiding in that absurd gap. Stocks earned about 10% a year, bonds about 5%. Sounds close, right? But compounding doesn't add your edge. It multiplies it year after year for 100 years. A small annual advantage becomes a 100-fold gap. Compounding isn't intuitive, it's violent. Now the honest fine print. That million came at a price. Stocks lost half their value 5 separate times along the way. The return is the payment for enduring that. Volatility is the fee, not a flaw. And everyone who fled at a bottom paid the fee and skipped the prize. And yes, this is American data, the century's winning market. Other countries' races were rougher, but the finishing order, productive assets first, lenders next, metal and cash behind, repeats almost everywhere. Because the deep logic is simple. A share of stock is a claim on human effort, people waking up every day trying to make the company worth more. Gold just sits there, waiting for fear. Cash melts by design. So hold the standings. Volatility is the fee. Inflation is the thief. Time is the referee. The race doesn't go to the fastest runner, it goes to whoever stays on the track. There's more where that came from.